Hi, and welcome to what is a 60% tax rate? Is it a stealth tax and how can it be avoided? And so before we start, this video is to demonstrate how to answer a taxation question in professional accountancy exams. So it will have some information in it on this subject, but if you're looking to use it in real life, you seek your own professional taxation advice and pension advice especially. And this video is fixed in time, it's in 2022, so an allowances and legislation changes. So let's look at the scenario. We're going to have a real life scenario that actually does happen in real life, and we're going to reverse engineer it into a question. So a CEO asks, what is the 60% income tax rate? She's never heard of it, but wonders if she's paying 60% tax. Is there a way to avoid it? Everybody wants to do, avoid tax. And her friend, which she's been talking to, describes it as the ultimate stealth tax. She earns £125,000 a year and she has no adjustments to her personal allowance. She also asks if you should do a salary sacrifice scheme for electric cars and you're a school. And in the scenario, it'll have the explanations of the pension scheme calculations and values in there. Prepare a note for her. So we go with typical A, B, C marks. A sort of statements of what things are, B's explanations, and C's then professional extension. So we've got our sort of upsides and downsides. So we've got our taxation rates here from the HMRC website, and what we can see is we've got these various taxation rates in here going up to £45,000 above £150,000. So we don't see a 60% tax rate in there, so there isn't a 60% tax rate in there. But what we do see is that you do not get a personal allowance on taxable income over £125,140. And if you look at personal taxation, your personal allowance for taxation purposes, you have £112,570 of personal allowance before you have to pay income tax in there. But that amount is reduced once you get taxable income over £100,000. What's it reduced by? Well, it's reduced by £1 for every £2 that your adjusted net income, your taxable income, goes over £100,000. So you get this sort of position where you've got zero allowance over £125,140. So let's have a look at how. Let's go over a real example. So we'll give an example, an A mark, and then we'll extend it. So we got this person, they earn £112,570. £112,570. They got their personal allowance of £12,570, so their taxable income of £100,000. At the tax rate of 40%, that's £40,000. We'll add another £10,000 onto their tax, so the income goes up to £122,570, and their personal allowance drops. So their personal allowance drops because this has gone up by £10,000. Their personal allowance drops by £5,000. It's dropped to that. So their taxable income is £115,000. Tax at 40% is £46,000. So for an additional £10,000 of income, they've got an additional £6,000 worth of tax. Their marginal tax rate is 60%. So this is where this 60% tax rate comes from. So what we can see really in our UK income tax rates, really we have hiding in here a tax rate of 60% between 100,000 and 125,140, where it's a 60% tax rate. So it is a stealth tax, it's hidden. So it's a hidden thing. So for a stealth taxation, typically they're hidden, and also they go against progressive taxation systems. So this person up here is earning £150,000. Their marginal rate of tax and all of that is going to be lower than the person who's earning £125,000. So it's a bit of a stealth tax and runs counter to a progressive taxation system. So you could have a question along the lines of UK system isn't progressive. Are there still ways to avoid it in the next part of the question? So we've got a method to reduce. What we've got to do is we're going to find methods to reduce our taxable income back to less than £100,000 really. And the main one is pension contributions. We pay pension contributions. They're not taxable up to £40,000 personal allowance in a year. And also as well, if we go over the 40,000, then we got 3 years of unused prior allowances that we can use up as well. You might have other personal allowances, but typically they're going to get reduced because of the amount that's been earned, because they're means tested. And then we got this sort of final salary pension scheme as well. And what we do need to always be mindful of final salary pension schemes is that their values tend to go up as people get pay awards, not just for in the year, but also the previous years of service that they have. So look now at the salary sacrifice. We've got this sort of idea of, well, with our pension contributions, we can get back from there, but they might already have the pension contributions. This was a school number, so the employer is paying in. And we've got the salary sacrifice scheme then on electric cars. How does that work? And how does the salary sacrifice scheme works? Just if you're not looking at this for a question, or even if you are looking at the question and you're considering this, just remember that reducing your salary may, and certainly probably will, reduce an impact on your other benefits, in particular pensions and final salary pension schemes, your redundancy payments, any death in service payments, anything that's sort of dependent or based on your salary that you're giving up. And so it's very possible to lose a lot more money than you save in tax if you don't really understand what's going on in an electric car, or in any kind of salary sacrifice scheme, but especially in an electric car one. So we reduce the salary and we take an electric car instead that's fully electric, if it's got a fully electric range of at least 130 miles. And if it's got that fully electric range, then the benefit in kind income becomes 2% of the list price. So how does it work in reality? Well, the lease cost of getting a car or buying a car is got about 12% a year depreciation on that car. And you swap that for this 2% benefit in kind cost. So you get rid of the 12% depreciation, which is taken out of the gross salary, and you swap it for this 2% benefit in kind. And so the difference between these two, you're about sort of 10% difference. You're better off at that higher rate of tax because you've sort of saved on tax on this depreciation, and then you've been taxed on this, and you've got a car at the end of it. But of course, it only works as sort of extension points. It only works if you actually want that car. And electric cars are expensive. So where can it go wrong? Remember, this was set in a school, so we've been given here the local government pension scheme regulations, and there's a teacher's one as well, which is very similar. And it says that an employee's pensional pay does not include any amount of the value of a car. So teachers' pension scheme and the LGPS pension schemes do not allow motor vehicles to be included as pensionable pay for the purposes of either pension contributions in the year by the employer, and also as well the final salary pension that the person would receive. So the pension contributions from the employer will be dropped in the year because they're not going to have the pension contributions on the lower salary. So it's probably about 20%. Let's say something that what the company would do. If it was a TPS or teachers pension scheme, those would be 23.4%. So let's say we had a lower taxation employee, and they were saving 20% income tax plus 3.2% national insurance, they'd be losing 23.4% pension contribution, so they'd actually be worse off under an electric car scheme, unless the employer pays the difference in ABCs, and then their final salary could drop for the salary given up for the car. Now, let's take a scenario where there's somebody who's got £35,000 salary in 10 years pre-2014 service, and they give up £5,000 of their salary for a 4-year lease on an electric car. Car's about £40,000 then in that case. Just after the lease, they retire. Without the pension, their actual value of their pension is £17,392 a year, and they get this little small lump sum as well. And so that value is about £353,000. In terms of taxation value, it's in the final year, it's £20 per pound of pension. During years, for the purposes of calculating personal allowance, it's £16 value for every £1 of pension. So without this salary sacrifice scheme, the value of their pension is £353,000. With the car, their pension is reduced because this final salary is reduced. And remember, we saw in the regulations it wasn't included in the pensionable value, and so their pension drops to this. And the value of their pension, sorry, it's not 4,500. The value of their pension drops to 330,000. So what we can see here is there's a £23,000 loss in the pension. They also, as well, paid for the car, so they would have paid probably about £13,000 for this car lease. So they paid for 4 years worth of driving of this £40,000 car, £36,000, which is a lot worse than the position that they could have just gone out and bought this car. So in terms of somebody who's going to retire on a final salary pension scheme, then they're going to do it after it, and especially if they've run this lease for quite a period of time as well. So there's not even the protections that are within those schemes. You can lose a lot of money. So in summary, just in terms of if you were looking at this because you're not an accounting student looking to answer a question, it is important to get professional advice, and so we put that in the answer. It's important to get professional advice based on the circumstances. You wouldn't stick your neck out as an accountant, as a finance director, to give taxation advice to the CEO. It's important to get professional advice. You'd put that professional extension mark. There is a 60% marginal rate of tax. It exists. And is it the ultimate stealth tax? Well, it runs counter to progressive taxation system, and it's hidden. So it could be described as a stealth tax. Hopefully, that's sort of giving you a bit of a structure about how to sort of take a real life scenario and turn it into a taxation question. Hopefully it was helpful. Thanks for listening. Bye bye.